Last week's market action looked harmless on the charts, but psychologically it was extremely damaging for most traders. A sudden shock on Monday, multiple false signals during the week, and a strong close on Friday left many traders confused about what really happened. The market did not trend aggressively, nor did it collapse, which made decision-making even harder. This video will break down exactly what happened between the 8th and 12th of December and why the market behaved the way it did. Welcome back to Wealth Maama, where we focus on understanding market behavior rather than chasing predictions. This weekly analysis is designed to help you see the bigger picture by combining data, psychology, and smart money movement. If last week left you confused, this breakdown will bring clarity. Nifty started the week around the 26,200, but on the first day itself it crashed to 25,900 zone and spent most of the week moving in a narrow range before closing above 26,000 on Friday. This was not a trending week but a testing phase where the market absorbed supply quietly. Volumes remained moderate, and there was no sign of panic selling, which itself hinted that the market was building strength rather than preparing for a breakdown. Global markets played a neutral but supportive role throughout the week. US indices remained stable, bond yields did not spike, and the dollar softened slightly, reducing pressure on emerging markets. Crude oil prices stayed range-bound, which helped avoid fresh inflation concerns. Because there was no global fear trigger, the Indian market was free to focus on its internal strength. On the domestic front, liquidity conditions remained comfortable and there were no negative surprises from the RBI. Foreign institutional investors were not aggressive buyers, but more importantly, they were not heavy sellers either. Domestic institutional investors continued to absorb dips selectively, creating a stable base for the index. This balance between FII caution and DII support helped keep the market steady. Monday's session changed the psychological tone of the entire week due to the sharp fall in IndiGo. As one of the most trusted and widely held stocks, its sudden decline shook confidence even though the index itself did not break down. Traders began to fear that the weakness could spread, but that fear remained emotional rather than structural. The market absorbed the shock without cascading selling, which was an early sign of underlying strength. Midweek traps and smart money behavior. From Tuesday to Thursday, the market entered a frustrating phase of low volatility and tight ranges. Small breakouts failed, and minor dips were immediately bought, trapping both bullish and bearish traders. This environment caused overtrading and impatience among retail participants. Meanwhile, institutional players used this low-attention phase to build positions slowly without pushing prices aggressively. Volatility and VIX analysis. Throughout the week, India VIX continued to drift lower even when Nifty was not making new highs. This relationship between falling volatility and stable prices is significant because it indicates comfort rather than fear. If the market were preparing for a sharp decline, volatility would have risen. Instead, the falling VIX suggested that large participants were confident holding their positions. Sector-wise performance. Sector performance during the week showed healthy rotation rather than broad weakness. Metal stocks strengthened as global commodity sentiment improved, while cement and infrastructure stocks moved higher on expectations of continued capital spending. Financial stocks provided quite support to the index, and IT remained weak but controlled without panic selling. Even the aviation sector weakness stayed limited to IndiGo and did not turn into sector-wide damage. Gainers and losers of the week. The stocks that gained during the week were largely institutional favorites such as Tata Steel, Hindalco, Ultratech Cement, and L&T, which indicated long-term confidence rather than short-term speculation. On the other hand, the stocks that declined did so mainly due to stock-specific or valuation-related reasons. There was no evidence of widespread selling pressure across sectors. Trader psychology for last week. Last week punished traders who expected immediate direction and rewarded those who stayed patient. Many traders lost confidence during the sideways phase and either exited positions too early or overtraded in search of clarity. The market intentionally stayed boring, which is often how accumulation phases are designed to test emotional discipline. Key takeaways from the week. The most important lesson from last week is that markets do not always move loudly. When volatility compresses and price remains stable, it often signals preparation rather than exhaustion. The market showed no urgency to fall, which is a positive sign for the broader structure. What this means going forward. With Nifty closing above 26,000 and volatility remaining low, the short-term bias stays constructive. However, low volatility also suggests that when the next move comes, it could be sharp. Traders should focus on how the market behaves on pullbacks rather than chasing breakouts blindly. That concludes the weekly market breakdown. If this analysis helped you understand the market better, you are already ahead of many traders who only react to price movements. Also, a quick reminder that the ICICI Securities IPO is currently in focus, and I have shared a detailed video explaining its valuation, risks, and overall outlook. Make sure to watch that before taking any decision. I will see you in the next market session. And until then, stay patient and trade with logic.